Dear viewers, as I've mentioned before, I track insider buying regularly. Most of the time, it does not lead to anywhere interesting. A director buying a small number of shares after a stock has fallen sharply is fairly common. Promoters occasionally increasing stake in their business is not unusual either. What gets my attention is a pattern. Over the past few months, one company kept appearing on my screen: CFF Fluid Control. The buying wasn't a one time event. The insider has been purchasing shares from the open market consistently from December 2025 through May 2026. What made it even more interesting was that they continued buying even as the stock price moved higher. Now, that is not what usually happens. Insider buying often slows once a stock rallies. In CFF's case, this has not happened. The obvious question was, what gives them the confidence to keep buying at higher prices? At first, I did not spend much time on it. CFF is listed on SME platform and I generally approach that space carefully. SME stocks can offer outstanding returns, but they also come with challenges of limited disclosures, lower liquidity, larger trading lots, and at times difficulty in exiting when the conditions turn unfavorable. Still, insider buying kept showing up, and curiosity got the better of me, and I tried to dig deeper. Here is what I found. For an SME company, CFF enjoys a decent market cap of over rupees 15 billion. Founded in 2012, CFF has evolved into a supplier of specialized systems used in naval ships and submarines. Its products include sonar systems, stealth systems, integrated platform management systems, and weapon related equipment. These are not standard industrial products, but mission critical systems where reliability, engineering, expertise, and years of qualification matter. The company works across the life cycle of naval platforms, supplying equipment as well as supporting maintenance, repairs, and upgrades. Furthermore, it also serves sectors such as nuclear and clean energy. Along the way, CFF has partnered with global defense companies and built relationships with major Indian shipyards and defense customers. According to CRISIL, the Indian Navy recognizes CFF as an authorized equipment manufacturer for several of its products that it supplies and services. It may sound like a technical detail, but it can be powerful advantage. In defense, the first order is often the hardest to win. Once a supplier becomes a part of the ecosystem and its products are qualified for use, the relationship can continue for years through spare parts, maintenance, repairs, and upgrades. For some products, CFF effectively becomes a single source supplier. The company also holds certifications and registrations which are required to work with defense shipyards and related agencies. These qualifications create barriers that are not easy for a new competitor to replicate fast. The story so far seems good, and the financial performance supports the narrative. CFF's revenue has grown at roughly 43% annually over past 3 years. In FY26, revenue growth was 43% year on year, while operating profit and net profit grew at a higher rate of 45% and 64%. The operating profit margin and net profit margins are healthy as well at 28 and 19% respectively. Now, given the demand suggested by order book, this trajectory could continue. The company's order book in 2025 is more than 2 times of revenue. The promoters continue to own more than 68% of the business, even after dilution from a follow-on public offer in 2025, putting decent skin in the game. The promoters bring over 3 decades of experience in the defense sector, which matters in an industry where execution capability and long-term relationships are critical. The balance sheet is another positive. Return on capital employed is around 20% and return on equity is roughly 15%. Debt to equity is low or negligible and the company even pays a dividend. Now, no investment story is complete without examining the risks. The biggest concern here is cash flow and working capital intensive nature of the business. Defense projects typically involve long execution cycle and milestone based payments. As a result, companies often carry higher receivables and inventory, and CFF is no exception. Despite reporting strong profits, operating cash flow as such has been negative because the capital is tied up in working capital. This is an aspect to monitor closely. The second risk is the nature of the defense business. While the industry is witnessing tailwinds, revenue growth still depends on winning contracts and projects that could be lumpy, leading to volatile financial performance. Then there is SME factor. Liquidity can vanish fast during phases of market stress or company specific problems. So investors need to be comfortable with that reality before taking exposure. Coming back to the insider buying aspect, the management has been buying shares consistently for several months from December 2025 to latest in May 2026, and this buying has continued even as the stock price kept rising. The latest purchase have been done at over rupees 700, which is close to current stock price as I record this. The stock currently trades at around 38 times. Now that's not cheap. However, with earnings growing rapidly and PEG of less than 1, the valuation looks less demanding. Now, this is not an investment recommendation. Insider buying should never be treated as an investment thesis on its own. Insiders can be wrong, circumstances can change. But when insider purchases are accompanied by healthy fundamentals and favorable industry tailwinds, it definitely deserves your attention. This is not an investment recommendation, but indeed a candidate worth studying. What do you think? Let me know in the comment section. Thank you for watching. Goodbye.